If you've got a mortgage on a property, you may find yourself in a situation where you perhaps want to clear your mortgage sooner with any surplus income. After all, a mortgage is debt, and there's this perception that debt is bad, which isn't always true. But debt comes with risk and the interest payments as well. While you may want to clear debt as soon as possible, you should bear in mind the power of investing early and compounding in building your wealth. The earlier you invest, the faster your wealth grows due to compounding. I've explained this in several previous videos, so do check out my channel if you want a refresher. So imagine you have some extra cash. The question is whether you should pay off your mortgage early or invest. As always, the answer to these types of questions is it depends. But in this case, I would say that more often than not, it's usually preferable to invest than pay off your mortgage early. And here's why. Mortgage interest rates are usually much lower than investment returns on average and in the long run. It's important to point out that investment returns are not guaranteed, and as you know, the nature of investments is that you may end up making money one year and losing money another year. In a broadly diversified index fund, however, the growth rate usually trends upwards in the long run, and you may be looking at a growth rate of anywhere between 6 to 8% return annually. Mortgage interest rates, on the other hand, are much lower, currently around 2 to 3% mark. On a pure maths basis, the money you invest returns 8%, but the debt you repay saves you 3% in interest. Hence, you can see why investments can be more attractive. It's the difference between the interest rate and the return on investment. To make things worse, if you do repay your mortgage early, you may incur additional charges or penalties, which means that you'll be saving even less than the 3% mentioned earlier. However, while it may seem financially better to invest than to overpay your mortgage, the risks are higher too. Mortgage interest may be fixed for a relatively short period of time, typically 3 to 5 years, meaning after this period the interest rate will adjust according to the current interest rates. What this means is that in the event that the interest rate rises, your mortgage payments will also rise. You can see where this is going. If you're unable to make your mortgage payments, then your property may be repossessed. Remember, your emergency fund can help you buffer against short-term fluctuations, but it cannot sustain you if you can't afford your mortgage, as this is a long-term commitment. Hence, the earlier you clear your debt, the lower the chances of losing your property. Overpaying your mortgage means you're less exposed to the stock market risk. In other words, while the better financial decision may be to invest, the less risky option might be to pay off the mortgage early, especially if there are no early repayment penalties. The latter option might help you sleep better at night. Let's take a simple example to illustrate this. Say you purchase a property for 375k, putting down a 75k deposit and borrowing 300k at 3% interest for 25 years. This means your mortgage payment is 1,423 per month. Some mortgage lenders will allow you to repay 10% of your outstanding balance per year without any penalties. But let's assume you want to increase your monthly payments by 10%, which sounds more reasonable. With the overpayment, you would be mortgage free in just under 22 years, that is 3 years earlier. But remember that money you put away to overpayment could have been invested in the stock market at, say, a 7% return per annum, much higher than the property growth rate assumed. This means that by the time you finish paying off your house, your investment portfolio would have grown by much more. This can be seen from the calculations. Near the end of 22 years, the 375k house is now fully yours, but now has a value of 648k due to the appreciation. In the normal scenario, at the same time period, you'd still have 51k outstanding balance on the house, but your investment would have grown to 88k. This means that you would have been ahead by 37k through investing. So it's not a massive amount, but these depends on the assumptions. For example, if your mortgage interest is even lower and the investment returns relatively higher, this makes the case for investment even stronger. Under those circumstances, the more you overpay, the worse off you are. But remember, investments, particularly what you invest in, can be quite risky, and you may not get those returns and possibly even lose your money. So it's very important to know what you invest in and what those risks entail. I've got plenty of videos on my channel, so do check them out. I hope you find this useful, and if you did, please remember to like and subscribe. Thank you for watching, and see you next time.